Good evening, everybody. Thank you for the invitation to the American Society to this interesting panel. I hope you can hear me well. Is it working well? Okay, great. As Guillermo was saying, I am the Director of Social Performance at Microfinance Information Exchange, MIX. MIX is a no-profit headquartered in Washington, D.C., whose mission is to promote transparency in the microfinance industry. And we do that by collecting performance information from institutions all over the world who are committed to serve low-income and poor clients with their financial services. So today we are gathered here with these experts coming from 3 different institutions to talk about a hot topic in microfinance, which is how can we measure social performance? How can we have sustainable solutions for microfinance, in particular for the context of Latin America? And how do we define the concept of sustainability? Sustainability for whom? For the MFIs, for the clients? And it's particularly a hot topic because in the last few years, microfinance has opened up to commercial capital. And so now there are different directions that we are taking. And it's going to be particularly interesting to discuss it with Rebecca Roof, who represents Women World Banking, who's a microfinance network with a strong focus on women, with Jody Rush, who's representing Moody's rating agency, and then with Carolina Velasco, who's representing Compartamos Holding. Compartamos is the biggest microfinance institution of Latin America. So I would like to open the discussion just presenting you a couple of slides from the data that we've been collecting at MIX. So in this slide, you can see the trend in reporting social performance information from MFIs to MIX. We started in 2009 to collect the social performance indicator, and in only 4 years, we have reached 900 institutions. So we can definitely say that institutions are starting to be very committed in collecting social performance indicators and reporting them to a public platform, in particular Latin America. If you observe the violet curve, you can see Latin America is above the rest of the world. What's the reason? I would like to hear from our panelists, but for what I've observed, I will say that the local networks have definitely played a very important role in the past years in terms of creating capacity building, but also because it's a different market. It's particularly developed. There was an important role played by competition, by regulation. But what about the ability of Latin American MFIs and the rest of MFIs in reporting their ability to reach out to their mission? So in this graph, you can see the first column is representing you have here 4 development goals among the ones that the MFIs have ranked to be their top priority. So it's poverty reduction, growth of existing business, employment generation, and gender equality and women's empowerment. The biggest bar is how many of these development goals are ranked to be the highest among microfinance institutions. However, the smaller bar is the percentage of microfinance institutions reporting to MIX who are actually able to provide any data about their ability to reach out their mission. So in poverty reduction, you can see that over 70% of institutions state poverty reduction as their main mission. However, less than 20% are actually tracking any poverty data regarding to their clients. You can look at the same comparison for the other type of development goals, and there is no much difference between Latin America and the rest of the world. Bottom line, transparency is gaining pace in microfinance related to social performance. Institutions are starting to be committed and reporting to MIX. However, when it comes to talk about are we able to achieve their mission, they actually are really struggling to prove that they're able to meet their goals. But this is a graph showing aggregate data for Latin America and around the world. But here we have experts that actually can talk about their own experience on whether microfinance is indeed reaching out their mission. And actually, I would like to start with Rebecca, asking about the experience of women-wear banking. So Rebecca, first of all, why is it so different? Why is it so difficult for a microfinance institution to monitor and measure their social performance? What are the challenges faced? And in the experience of women-wear banking, what is actually your action plan to measure indicators, especially from a gender perspective, so to be sure that your mission is achieved?
Sure, no, thank you. Can you hear me? Thank you, Mikal. It's a pleasure to be here. I think regarding your first question, in terms of some of the challenges that we've seen in some of our work, particularly in Latin America, we've seen that we really need to build a business case for tracking and for really incorporating some of the social performance indicators. In Latin America, where we find some of the most sophisticated, some of the more efficient institutions that really work in very competitive markets, they have very strong credit methodologies, yet in a way they've been slow to adopt some of the social performance measures. It's interesting to see that they're actually some of the ones that are reporting more information, or that are the MFIs have a higher, that they're reporting, more MFIs are reporting on their social performance, but some of our experience has been that they've been actually slower to adopt some of the more client impact or client social outcomes methodologies. So some of the I guess, lessons learned we found is that when you're implementing social performance initiatives, you really need to go deep and really work with all of the different departments in the institution. So in our work, we've really worked with different operational areas, including credit, marketing, HR, and it's very important that they find the indicators useful, that they actually incorporate them into their management decisions. Because if they are coming from external sources, and if they're actually just using them to report to somebody else, and they're not incorporating them into their day-to-day, there's really not going to be any buy-in. So, a good example we have is in Latin America, for example, one of the other challenges I wanted to talk about is training, actually. And training is really key to making sure that especially the loan officers, but other staff really understand social performance and the value of using data when making decisions. So the example I wanted to focus on is in Latin America, we've seen that as I mentioned, the institutions have very strong methodologies, but for example, in some cases, socioeconomic data is not being updated because they don't really use it. So we've seen in these cases that the data is not clean, so we can't really use it for some of the social performance purposes. So some of our learnings from Asia that we found that, for instance, education can be a really good proxy for income level. But if the loan officers are not actually using this data, then they really don't have an incentive to track it or to update it. So we've really been working on developing some good trainings and working with the loan officers in-house to make sure that they incorporate the use of social performance, and it's not just something that's externally. And then very quickly on your second question regarding gender performance indicators, we launched this initiative in 2011, and really what we saw is that we really wanted to focus on women as a distinct market segment. And in the past, the standard metric by which a lot of the MFIs have been judged as to whether they're actually serving women has been % women clients or % women borrowers. But in our research, we found that in some cases, for instance, some institutions had higher percentages of women clients, yet they were actually not serving their clients well. In qualitative studies that we did, we found that the clients actually perceived that they weren't being served well. They thought that the institution did not value their services. So clearly, even if you have, let's say, 70% women clients, that doesn't mean that you're serving them well. So we launched the initiative to really focus on what it means to do that, to serve women well. And we're currently beta testing our framework in 3 MFIs. We developed a framework that's really complementary to a lot of the social performance initiatives out there to make sure that we can work together and ensure that that other initiatives can then also use our indicators related to gender performance. And just to give you very quickly a couple of examples, we found, for example, that we know that client retention is a very important measure if you talk about going beyond outreach. So as a first cut, we talk about disaggregating the data. Are you disaggregating data between men and women? And in Latin America, we have found that, not surprisingly, women are more loyal customers than men. When we look at retention rates for women of 68% compared to 62% for men. But once we know women are more loyal, how do we keep them as customers? So our research shows that poor women really value convenience, and because they have barriers to mobility, cultural barriers, as well as numerous responsibilities inside and outside the home, it is very important for them to have convenient service points. So some of the indicators and some of the information that we're tracking is also related to how many alternative channels that the institution has, what are the different, the number of branches, the number of points of services to ensure that you are serving women well. So these are just a couple of examples of some of the indicators that we're working on. We're finalizing our framework at the beginning of next year, and then we'll be able to disseminate all of our findings to the industry.
Thank you, Rebecca, for this gender perspective coming from Women World Banking. We are definitely looking forward to see what are the results of this indicator, because perhaps we could include them also into reporting to mix. Actually, Absolutely. We are looking for valuable type of indicators that really work for women. So my next question here is to our rater, Jody. And I am particularly interested to see Moody's that have recently developed a social rating for microfinance. We all know that Moody's expertise is specifically for the financial sector. So I'm very interested to know how have you come up to develop this model, and specifically if you have adapted or perhaps not adapted your financial traditional rating model to the social rating model for microfinance. What type of similarities and differences there are from your traditional model to going to microfinance?
Good.
Thank you.
Oh, good. Thank you, McCall. We came out with our social performance assessment probably about 4 months ago. We've just rolled it out. We're in the process of doing our first 5 assessments that should be done by early next year. The approach that we took to this was a sort of an industry approach to determining what measures social performance. I mean, the first question that you get was, we want to measure social performance. The first thing you say, well, okay, what is that? It could be, it's like the old accounting joke, how much is 2 plus 2? Well, what do you want it to be, right? So that was the first thing we needed to determine. Now, ultimately, it's, are you meeting certain social objectives? For example, it could be women empowerment, it could be bringing people out of poverty, and so on. But to use that as a rating criteria is difficult for a number of reasons. The first is that in order to determine that, it's extremely expensive for the institution, because you've got to do all these like randomized control trials and so on, which most institutions can't do. The second problem is that it tells you what you've done, not what you're going to do. And so from the standpoint of a rating is supposed to be predictive. It's supposed to tell you what's going to happen in the future. So what you've done in the past is important, but it's not necessarily going to tell you what also is going to happen in the future. So in order to know what's going to happen in the future, what you really want to know are the processes and procedures that the institution has in place to assure that they're going to be able to perform in the future. Now the question is, what are those? Well, actually, 2 of the 3 people up here, and actually, I think you guys did too, you may not have remembered. What we did is we designed a question. Well, we put together a small group of market experts, Rebecca and McCall being among them, and we basically asked them, if you were going to measure social performance, what would you want? What would you measure? What are the different factors that you would look at? And after going back and forth with this group, we got actually 44 different factors that they would consider important for measuring social performance. Those were then grouped into 6 main categories. Then what we did is we used a methodology or modeling technique that we've used in the credit area as well, where you develop this questionnaire where you kind of analyze or you rate one practice versus another as to importance. And we sent that out into the markets. We had 74 responses to it. And each one would, and because every item is measured against every other item, it's you put the questionnaires through an algorithm, and what comes out of an algorithm is a scorecard. So we have 74 different scorecards, and we took the mean of that for all those 44 different factors. And most people, when they, actually it was the next one was, so that gives you the high-level factors, but it doesn't tell you what the actual practices are. So we took that and then we did another survey where we did a literature search and finding all the different practices that were out there for all the different factors. So we're looking at indicators. For example, pricing transparency is one of our factors. But to be doing a good job in pricing transparency, what actually should you be doing? Like disclosing the annual percentage rate, giving the client a list of what the actual monthly payments are going to be, and so on. So we needed to get to that level of detail. So the literature search gave us that, the possibilities. We vetted that in different ways. One was with Women's World Banking and some others, and then we finalized that. And we put together a group of experts, and we gave them a questionnaire to kind of fill out as to what the practices were, which were more important than the others, and so on. And this questionnaire took about 2.5 hours to do, and everyone thought it was interesting. McCall's boss thought it was fun, but he's, he's a little bit too much of a geek, I guess.
And it took me 5 hours, not 2.5.
It took you 5 hours. Well, you were always a little slow, Rebecca. But after having finished that, we actually got a very detailed scorecard with the indicators. And there's a lot of, we're actually in the process of finalizing a white paper on the whole process to develop that. And then you have to go from the indicators to a rating scale. And so to do that, what you do is you come up with like an absolute, there are 2 ways to come up with the rating scale. One is you have a relative rating or you have absolute. Relative rating is saying we come up with 5 grades. And you can say, well, a certain percentage of the institution should be the top grade, a certain percentage the next level, and so on. We didn't think for microfinance that was something that would work because it could be what the best practices are. Nobody should be in that level. So you don't have, it's not a mature enough industry to do that. So we came up with absolute standards, again, based on our literature search. And then we actually used the data from the mix where we took all their social data, we mapped it to our scorecard, and then we actually rated the 349 MFIs after we had cleaned the data, and then we looked at what the distributions were, and we did some iterations on this. So that's how we actually got the rating scale. It's not that much of a different process that you'd get from the credit side. Now, the delivery of the social performance, we're actually using the model for credit ratings. So the way that works is you start with, well, first you sign a contract. That's the hard part. And once you've done that, then you collect data and you do a desk review. Then you schedule a site visit, visit branches, you talk to clients, and so on. You come back, we fill out the scorecard. The scorecard will give an indication of what the final assessment grade should be. It's then presented to a committee, and the committee then will decide what the actual assessment grade will be. It doesn't have to be the same as the scorecard. There are reasons why you'd want it to differ, additional information, and so on. And then ultimately the assessment grade is released and published on our website. So that's a very similar process.
Okay, thank you, Jody. So I'm going to follow up with you in a second. You gave us interesting things to think about. My question to Carolina. So I'm interested to know, here we are talking about a sustainable model of microfinance for Latin America specifically. So what is Compartamos' vision of sustainability for microfinance? And what type of products have you developed to meet such a vision? We know that Compartamos has actually expanded beyond Mexico. They went to Peru, now they're in Guatemala. So I find it particularly interesting to really know what is actually your current business model and your vision for the future, where you are heading to.
Okay. Well, thank you very much for the invitation. I would like to approach this question with a brief summary of Compartamos' story. We started on the early 90s as an NGO, and since our beginnings, our main purpose or mission is to eradicate the financial exclusion. So these all our steps and all our actions have been aligned to try to accomplish this purpose. We started as an NGO, then we transformed our operations in 2000 as a regulated company, and in 2006 we transformed our operations into a commercial bank, which give us more flexibility in terms of products, but we also face some challenges in terms of regulation and what they thought that would be suitable for us to bankerize the low-income segment. And then, we also start evolving our business model, and we find out that if we wanted to expand our operations through Latin America, the bank, will not allow us to have like a more quick response to the different opportunities that we were facing. So that's why in 2010 we created a holding company, which is right now the public company, not longer the bank. And through this holding company, we see that we have evolved completely our business model. We have right now 6 subsidiaries. The main one is remaining the bank, in Mexico, which is still operating, and we have our main product is the Crédito Mujer, which is the village banking methodology. We have over 2.4 million clients and a portfolio over 13,000 million pesos, and a branch network of nearly 500 branches. We, in terms of the bank, right now we have different projects, strategic projects. One is that we started the saving pilot product. Right now we have more than 50,000 accounts, from different clients. And actually we also are making a huge investment in our transactional core system. We're working with SAP. To do that, and also in terms of productivity and efficiency through our loan officers, we are having trying to implement technology and having handheld devices that will help them, to be more efficient in the operation, to locate in a more efficient way potential clients, and to map the route that they have to cover, not just through the day, but also through the week, and also capture information in a more easy and efficient way. The second subsidiary is Financiera Crear at Peru, as Nicole mentioned. We expand our operations. We acquire a part of this institution on summer of last year. The main operation of Financiera Crear is based on individual lending, and they only have operations in Arequipa and Lima, and one of our challenges is trying to have the Crédito Mujer, the village banking methodology there, because what we have seen is that in Latin America, the trend is that most of the institutions are focused on the individual lending rather than the group lending, and these are one of our strengths, and the thing that we really know how to operate is the group lending. So that's one thing that we want to do that. We have started a pilot, and right now we have in this product in Peru. And the other challenge that we have is to try to expand the operation through the country, not just in Arequipa and Lima. Also, on summer last year, we started. We have a startup operation in Guatemala. It was for us a surprise of how the growth that we have there. Right now we have nearly 40,000 clients over there. In just a year and a couple of months. And we have 15 branches there. And well, our challenge there is keep on growing, not just in the near the border of Mexico, but also in the rest of the country. In the other side, we the fourth subsidiary that we recently created is a joint venture with another broker. I might say it's one of the largest brokers in insurance in Latin America, And what we have created is a microinsurance broker, That what we are having with this joint venture is that they have the knowledge of the industry, the insurance industry, but we have the knowledge of the market. And with this, we have created, this joint venture, and we are building and developing new products, It's not just going to attend the operations of Compartamos as a group, but also, going to attend another types of clients, And right now, we have 25% of the market share through this broker. And we have found different improvements specifically for Compartamos Bank through this broker. As operating it as a bank, the microinsurance products, what we faced is that we have a 48-hour response whenever a client makes a claim. Right now, we have improved these 48 hours into 24 hours, And this is like a very huge impact and improvement that we have done in this operation. The other the other subsidiary that we have is it's a network of correspondents, That our main challenge is to affiliate the mom and shops that are through the country, which will allow us, and specifically not us, but allow the client to have more accessible products. And actually what we have defined is that we want to be on the last mile, And these mom and shops will help us, through a specific system to attend, and have more accessible financial products to them. And the last one is a foundation that I think that we're going to be talking about it in the future.
Great. So thank you, Carolina. We have heard here a very particular model of aggressive growth beyond Mexico. Through product innovation, we have heard now about a new product that Compartamos has been developing. So, Rebecca, I am interested to know what is women-wear banking approach to product innovation, specifically for your women clients. How do you use your market research? If you can give us perhaps some example of market research that you have done specifically targeting to improving women access to financial services, but also to foster empowerment. And actually, I will be personally very curious to know what is your definition of women empowerment, because it's always a terminology that is always used. Microfinance is leading to women empowerment. So can you please enlighten us?
Sure. So yes, that's a great question, and we place a very high value on market research when we work on the design of products. We see that women have very specific life cycle needs, and the only way to be able to really meet those needs is to have a strong market research component. So I wanted to tell you about a very exciting new project that we've been working on in developing a rural credit product, specifically in Latin America. We're working with 3 institutions in Colombia, Paraguay, and Peru. And much of the product innovation work that we've been doing has been guided by the market research that we've been doing. So we conducted market research through focus groups, one-on-one interviews of women and men clients, women that were, and as well as women that were not clients, to really figure out their needs, figure out their life cycle. And these institutions had a rural product before, but they were not able to really target women or serve them well. So they were very interested in sort of redesigning the product to really meet the needs. So what we found is women's economic contributions are very important for the family of rural households because they see it as an extension of household work. So they are not, but they are not being valued by herself, her family, the financial institutions, or by society. So essentially what we found is that they really are invisible. So for example, women will milk the cows, they make the cheese, they take care of the chickens, the pigs, and they get very small amounts of income from these activities. But this income actually is used to cover the expenses of some of the main agricultural activities. With this income, they pay for fertilizers or other agricultural products. And these major agricultural activities are actually driven by the men. So this is perceived, the agricultural activities as perceived as the main product, selling cows, harvesting, et cetera, and the income that the men get is much larger, but it only comes once or twice a year, whereas the women's income comes on a continual basis. So from a social performance standpoint, these findings were fascinating to us because it really made us see that we are uncovering an otherwise unattended market, an invisible market that was not being seen before. But just as importantly, what does this mean for the sustainability of the institution? And really, we saw that women's income generating abilities were really being undervalued. Some of the most interesting research that we conducted was basically we sent to the field loan officers of the institution going with credit experts from women's rural banking. So when they did their credit due diligence and they started asking the questions to see what was the income generating activities and the income and the assets of the men and the women, essentially the men and the women were undervaluing completely the women's activities. Women's activities in general yielded between 25% to 60% of the total household income. Yet when they were asked, what does your income actually yield, they were saying it's nothing. It doesn't really contribute to anything. So they actually our colleagues performed cash flow analysis, and they really saw that women's income and assets were being undervalued, while men's were actually being overvalued. So using this research, what did we do? We really worked with the MFI to be able to adapt the existing products and be able to better meet the needs of women. So some of the things that we did, for example, first we modified the existing credit methodology to really be able to better measure the entire family income and the growth potential of all the income-generating businesses. And here, training of the loan officers was really, really important to make sure that they were asking the right questions, to make sure that they were valuing the women's activities even beyond what she considered to be income. And second, we redesigned a product that would be really targeted to anyone that has a productive activity. So not just cash crops, but really any kind of non-productive activity. We also redesigned the product so there's more flexible loan terms, so there's more flexible requirements, so very little requirements because rural women may not have even an ID, so making sure that she can access that product, and also having flexible collateral, as assets in these areas are traditionally owned by men. So we've actually, I just got off the phone this afternoon with the person that's leading this project, and she gave me some really interesting results. We just finalized the pilot, so you're getting something hot off the press. And some of the interesting findings of the pilot, now we're moving into the expansion phase, is really that 99% of the clients reported that this was their first loan in a financial institution ever. So we really are banking the unbanked. And feedback from the clients it was very, very strong. They really value their relationship with the loan officers. A lot of these women have never been visited at their home before. And just having a loan officer come to their house, and offer them a financial service is extremely empowering to them. So to me, that would be the definition of empowerment. And they also feel very valued from their loan officers. They feel valued that their loan officer remembers their name, for example. They've never received this kind of customer service before. So once we finalized, this is thank you. This is the project that I'm talking about in Paraguay, and we're also working in Peru and Colombia. And we'll be rolling out those, we're in the process of rolling out those pilots. And then we'll be focusing on the expansion of the rural product in Latin America.
Very interesting, thank you. And I do like, actually, the connotation that you're giving to women empowerment, also in terms of visibility, that is the very first stage. So thank you, Rebecca, and we are really looking forward to reading these findings. So my follow-up question to Jody, I found it very interesting how Jody was explaining before the methodology that he came up with, because basically, he was consulting the usual friends of the microfinance. So here we have two, and then other investors who are commonly defined as the socially responsible investors, aka the ones that care about social performance. So what about the very majority of the investors that actually do not care about social performance, that are actually entering into microfinance because it's profitable and because they might get high returns? So Jody, how would you approach a purely commercial investor? How would you convince him that it makes business sense to use a social rating like the one developed by Moody's for actually getting into microfinance?
Okay. I'll try my pitch out on you, and you tell me if it works, okay? I don't think there's such a thing as a purely financial investor. In reality, and I've had this conversation with investors who say, well, I don't care about the social side of it. And we have a scale of 1 to 5, with 1 being the best and 5 being the worst. What they actually mean is that they don't care if it's a 1. But if I were to tell you everyone you're investing in is a 5, now you're a financial investor, would you care? So, it's a question of how you use this. And to say that I'm investing in institutions that actually don't really care too much about their clients and don't really have any systems in place to monitor whether or not they're helping or hurting their clients, and think about things like reputational risk and so on. So you don't want 5s, right? You may not care about 1s, but there is a level of social performance that you expect of your investees. And so a financial investor might be very happy with investing in 3s or maybe high 4s, but but at this point they have no idea what they are investing in, right? They just, if they don't care about it and they don't look at it, they don't have no idea. The second issue is that I think the markets have shown, like what happened in Nicaragua, Andhra Pradesh, and so on, that social risk can very much lead to financial risk, particularly what we look at in terms of tail risk. Right? When you have a no pay, when the government is telling people not to pay because the institution has done something that is socially wrong, now this is a social risk, right? And that has a huge financial impact as well. Government regulation can have a huge financial impact as well, and government regulators, they're concerned about whether or not the microfinance institution is doing good for their clients. And one of the things that we plan to do, and I've got a meeting in D.C., actually McCall's there also, with development agencies, is trying to look at the social performance assessment is not just a way of the individual institutions assessing their own performance, but be able to aggregate that information and show what the actual social performance of institutions are. What are they doing well? What aren't they doing well? Where they need improvement? Use that as a way of communicating not only with investors but regulators, because if you have things like interest rate caps or restrictions on who you can lend to or taking deposits and so on, that has a financial impact as well. And the regulators want to know like where the regulation is needed. And without information, they have no idea, and you risk having regulation that is incorrect for the market, or maybe not having regulation where it's needed. So the social assessments that we're doing, one is, I think everyone cares about that, and it's a question of just how much. And you need to monitor it to know where you stand or where your investees stand in that continuum. Second is that I don't think there is a difference between social risk and financial risk, particularly on the tail. And third, I think if we look at it on a countrywide basis, there certainly is regulatory risk and reputation risk. So did I convince you?
I think it was interesting.
All right. That's not the same as saying I convinced you.
But we are open here to a different perspective. And actually, I think that what Jody said is links very well to my next question to Carolina. Because if I heard correctly, Jody, you were saying perhaps there's nothing like really purely commercial investors coming to microfinance. But when it comes to talking about Compartamos, often actually the debate is just about that. There are two schools of thoughts. We do need to provide more financial access. So Compartamos has a strategy of growth through the access to private capital. But people say, well, but then if you give access to private capital, how can you balance the interest of the private shareholders to maximize their profits with the interest of what should be the social mission of microfinance, that is setting up fair and transparent prices to their clients and reaching out to the poor population. So I am interested to know really how did Compartamos internally deal with this tension, with this, I would say, ethical debate that I'm sure you have had, because you were born as a no-profit, as you were saying, 15 years ago, and then you went through commercialization and then the IPO. So how you really dealt internally with this? Did you come up with a different type of code of ethics than the one that you had before? Did you feel that your mission has actually changed, whereas it remained the same? And actually, it might be also interesting to know a little bit about how you are reinverting your profits into the community. So what type of social added value you are creating?
Okay, a lot of questions. First, I would like to say that even though Compartamos have been transformed through different, in the different stages of our operation, I will say that since our beginnings, we thought, and what we want is to generate, three different values: the social, economic, and human one. Now, even though we were an NGO, we knew that in a short period of time, the NGO will be like very flexible for us to keep growing, because the only way, when you see Mexico and a very huge demand of working capital loans, is that the pocket, that you have of money, to try to lend as much as possible, or to attend, the largest amount of people, is limited. And it's very, very limited, And we have seen it not just as an NGO, but also as a financial institution with the crisis of the past year, So since our beginnings, we were very committed with this, trying to generate the social, economic, and human value. And the group of people that started the operation as an NGO are still right now investors of the company. So if you see, there's like a continuity of what they envision, of Compartamos, and that right now is still in place. The other thing is becoming a public company. What we face is that we have to educate our investor, and try to let them understand what our clients are, what they're looking for, and we are very, very active on that, not just with the road shows, but I might say that mostly every week We have investors visiting our operation, and not our offices, no, but going and visit our clients and be free to ask them whatever questions they have. No, so they really get to know the impact that Compartamos has, and that the economic or our returns that we have, it's not our main purpose, no, but attending as much people as we can, no, will give us the economic, no, it's a consequence of attending the people. So, in the other way, no, if you see the average loan of Compartamos has not changed mainly in the years, no, our average loan mostly it's around $500, no, and if you see the microfinance industry in Latin America, the average loan is around $1,000, no, so that's when you see that we also have maintained, no, our mission, and that we're focusing on the same type of clients in the same segment of the market, no. Our code of ethics, it's not that it has changed, but it has been more stronger each day. And I think that in the industry, no, and for some organizations such as Smart Campaign, no, that are focusing on client protection, they have recognized that our code of ethics is one of the best practices that the industry can apply. No, and we invest a lot, no, as Rebecca told, no, the training on not just the loan officers, but all the employees to really get to know the philosophy of the company. It's one of the key issues, no, and if you see our strategic pillars, no, one is to maintain our philosophy through the years and through all the employees, no, and we do a lot of actions, no, through that, no, and also through our clients that goes beyond the credit that we give, no. For example, we have in terms of also what do we do in terms of social and corporate responsibility. We, since 2006, no, the board of directors have approved 2% of the annual net income to be donated for these programs, no, and we operated it in two ways, no. One is through other institutions that are specialized, no. This year, no, we are funding 13 programs, no, and we have donated 8.5 million pesos, no, and the rest of the amount, that it's totally 43 million pesos for 2012, no, we have different programs such as volunteering. We have a community day in the communities that we operate, no, where we give like different like financial education. We trying to reconstruct or rebuild the park or a public school that it's in the community. We also have like these like health brigades, no, to our clients and to the community. So we have like different projects, no, that comes to for these 2%, no, but also, no, from in our own operation, no, we have a lot of things that we do, no. We are very concerned about financial literacy, no, not just supporting this by the 2%, but also as part of Compartamos day-to-day basis. No, we have a magazine that is focused to our clients. We have annual events with our clients where we have like motivational speakers, but as well we have we try to train them and teach them different aspects of the daily challenges that they face.
Okay, thank you. So I hope you are taking notes for some follow-up questions, not to leave the job just to me. But I have a question for Rebecca. So Rebecca, women were banking so much at the forefront in microfinance about really trying to measuring indicators that make sense for improving the life of the women. So if you have to give us some examples of lesson learned, what works best for the women in terms of product development, in terms of meeting their needs, that could be replicated perhaps in not just in Latin America, but also in any other region in the world for every MFI who has a strong focus on women. What are the steps to follow for coming up with something that really works?
Sure. So we've developed, as I mentioned, a framework that really focuses on some of the most important areas that we believe, based on our research for the last 10 years, that when you're talking about serving women well, these are the different areas that we believe institutions should measure. So we developed a framework. This is sort of a draft copy that we're still working on. And we really believe, as I was mentioned, that, for example, product design and delivery are very important areas that institutions that focus on women should expand on and should measure. So, for example, as I mentioned before, conducting market research, making sure that your product design is informed by women's needs, making sure that the institution is offering a diverse set of financial products that are able to meet the needs of women. So women have very distinct life cycle needs. So we find that credit products, savings products, health insurance products, and other types of insurance are very important for them. We also see that financial education, for example, is quite important, and not just traditional financial education like a classroom training, but we've also focused in some innovative initiatives, such as we developed a telenovela, for example, in Dominican Republic with our network member in Dominican Republic, Banco Adopem, where we really included some of financial education messages within the telenovela, so that the women that were, obviously telenovelas, as many of you know, are big in Latin America. And so as part of watching that, and as part of a lot of the ad campaigns that accompanied this telenovela, we also developed a savings product. Through the telenovela, and actually since Q3 of last year, the new savings product at Banco Adopem has increased by over 80% in terms of the number of accounts. So there's no causation there. It doesn't mean that the telenovela created this, but there's certainly a correlation, because it creates this awareness, and then it also educates the women. So thinking of innovative approaches to really educate women on their financial management is very, very important. Other areas that we also find very important is outreach. And as I mentioned before, as an industry, we were just saying, if we serve women, we talk about the number of women clients, but we must go beyond that. As the private sector works, what is your market share? What is your market penetration? Are you looking at underserved markets, rural markets where women are invisible, as I mentioned before? Are women gaining access to the formal financial system? We see that particularly in Latin America, but particularly in other regions such as Africa, women don't even have access to the formal financial system. So how are you measuring these areas? And a very important area that we focus on is service quality. And I think this is something where a lot of times we think that the poor may just be thankful of receiving a loan, but in very many institutions we found is that women do absolutely value customer service, and they're willing to pay a higher interest rate for institutions that treat them well, for institutions that have nice branches where they can bring their kids, have them play in little areas, and they can spend the time. I think a lot of us know we have a lot of responsibilities at home, we have a lot of responsibilities at work. This is exactly the same as people in New York City. So they value time, so it's important to have branches that are accessible to them, branches that are close to them, and then service points that really are able to meet their needs. So these are just some of the areas. I could go on, but one of the areas that we actually tend to downplay, but is very important to what we do at Women's World Banking, is the area of diversity. So we talk about not just our external customers, but also our internal customers. And this is something very important in social performance as well. So are you a diverse institution? Obviously, we talk about gender, but we can talk about other areas as well. In a lot of the institutions we've worked on, we see that women have certainly play a big role in their staff, but as they're being promoted and they get to higher levels, as a lot of the institutions have been transforming into for-profit institutions, the diversity tends to dwindle a little bit. So are you measuring diversity? Do you have policies in place to protect women and help women? Do you have benefits that will help women, flexibility, et cetera, et cetera? Loan officers have very demanding schedules. There is issues, security issues. So if we want women to continue to be loan officers, how are we making sure that they have the benefits and they have the flexibility that they need? So these are, just some of the examples that we look at, and when we talk about really measuring gender performance.
Excellent. Thank you very much, Rebecca. Jody, so as you were saying before, you've just only recently launched your new social rating. So I guess it will be very difficult for you to highlight some of the challenges that you have observed in first person through your rating, because I don't know if you have piloted perhaps a few assessments, but if you have some feedback to share with us about the challenges that you have observed through these exercises, it would be great to hear. But if you don't have, just from your personal point of view, what do you think are currently the main challenges for MFIs to put social performance at the forefront of their operations, and how can we collectively as an industry help MFIs to overcome these challenges?
Okay. Well, let me try to put both those together. So what we've done, and actually what we've been presenting at a lot of these different conferences, is that we've actually taken the data that's been reported to the mix, and we map that data to our scorecard. So that, for example, in Latin America, there were about 155 institutions that we actually had data on. And we can't map everything, but on a high level, we can see how institutions are performing, and according to admittedly self-reported data, what they're doing well and where they need improvement. So I have some of the results here. And first we looked at overall. Now this is, again, it's a scorecard, so it's a scale of 0 to 100. The mean score for, and in fact, Latin America is very close to the world average. I was in India last week, and India was actually somewhat above the average, but Latin America is pretty much right on the average for the world. So the overall score that they would get for under our social performance rating scale would be a 62. So and this was based on more like 2010 data. 2009, the average score was actually closer to a 55. So that's actually shown some improvement and I think some recognition of what the issues are in social performance. Some of the areas where they've done well is first in social mission. Most institutions seem to have a strong socially oriented mission. Also some other areas that they do well. Well, actually, management quality is an area that is actually pretty average. The mean in Latin America was 50 compared to a 54 for the world. So that's really pretty much a very average score. There are a lot of different components within that we could break down if we had that level of detail from doing the assessments. What I thought was interesting is that strategy and leadership tends to be pretty low, a 40 and a 41 for the world. And one of the reasons why this surprised me is that this is self-reported data. And strategy and leadership, it's either these MFIs should think about who they're having fill out these things or what's going on there. But that also, you see things like that, and it gives you a little bit more confidence in the quality of the data and the bias, and whether there's a bias in the data or not. Interestingly, customer protection is an area that most MFIs score fairly well on. It's a very weighted toward the upper scales in that. And but the areas where they don't score particularly well is in governance, which was an average of, Latin America was a 37. The world was only a 38, so basically the same. And customer relationships, they do well. But the other area that is low, and this probably shouldn't come as a real surprise, I think, to anyone up here, was depth of outreach. That was a 30. So even though you have, and I think McCall's data supported this, which is not surprising because we built ours on that. We just did the weightings according to what level everyone thought was important. So institutions are saying that they have a very strong social mission, but when it comes down to who they're actually lending to or providing services to, it's not quite as good as they would like, as it should be. Now, the question is, the second part of that question was, how do we get this message out to the markets that social performance is important? Well, partly the market has gotten the message back to the MFIs because of various crises that have occurred in the market. But what we're doing is we have a number of different efforts out there that we're trying to look at this partially as a way for the MFI itself to find out what their practices are, but also partly as a research project. In other words, the markets need to know what's going on, because what happens is, you ask the question, does microfinance work? So you can show the pictures of the woman with the sewing machine who, is making money and, has employed 3 or 4 other people who now have sewing machines, and that's a good part. And then you have the other story of the farmer who, took out these loans and got over indebted and then committed suicide. Now, both are true, but that doesn't tell you what's happening in the markets. The only way you know what's happening in the markets is if you have data and you know what, the debt collection practices are. You know what they do for what institutions do to protect against over-indebtedness and things like that. The problem is the information isn't there yet. The mix, I think, is doing a very good job with doing that, although self-reported data, so that can only get you so far. They also report the data, but they don't have a methodology as to how you put that data. That's not their purpose. So organizations like Moody's, what we want to do is take the data from the social performance assessments we do and put it all together and present it to the industry as to what's going on. The next step would be also working with outcome indicators, because right now what we've built is what we call an expert system. We have all the different weightings of what's important, what's not important, but that's based on experts' opinion. It's not based on econometric modeling. So if we were to look at things like training, how important is training? Right now we have the opinion of the market, but if you can actually start looking at outcomes and then starting to regress that against actual practices, you then may be able to come up with causality between the two. I mean, we do this in credit right now. We don't do randomized control trials to figure out what the risk of credit default is. But the main difference is in credit, we have years and years of information that we can draw on to do these regression analyses. We don't yet have that in social performance in microfinance. So what our effort is to start collecting that data, doing the econometric modeling. Now, in order to do that, we need to work with partners. So, for example, Women's World Banking, we talk to about this on a partnership basis. We're talking to development agencies. We have a very interesting proposal that we've been working with Deutsche Bank on, where they would actually do, and it's something we'll probably come out with next year, where they will do a bond offering or an investment vehicle where the interest rate would be tied to the social performance of the institution. And what's very interesting about that is it starts aligning everyone's interests. If you look at social risk, and that if you can reduce the social risk, the investors are better off. And then on the side of the microfinance institution, if they do well socially, they actually save financially and they can pay for their social rating. So we're trying to come up with different types of ideas in order to address these type of issues to get that information out into the markets.
Great, thank you, Jody. Before asking the last question to Carolina, I just wanted to mention something about mixed methodology of collecting social performance indicators. So as Jody was saying, they are self-reported type of data. We do have our internal system, however, to check the quality of the data for much that we can, because we are not a rating agency and we cannot go on the field. However, we have actually recently developed a validation methodology together with the Social Performance Task Force, and actually we have done like Jody did. We went to the investors and we've been interviewing 13 socially responsible investors, asking them if we had to come up with an off-site type of validation methodology. That means what type of policy documents or study shall Mix collect from our office in Washington, D.C. and our local offices around the world in order to double-check the quality of this information. And so very soon, early in the new year, we are going to launch this new validation methodology, and we are going to collaborate with the local networks to do our off-site due diligence. So we hope that through our work and then through, of course, the work of the raters and of auditors, we can come up very soon with a very strong and reliable social performance data set for the industry. So my last question to Carolina is a more broad question about Mexico. So, in your opinion, what are currently the main challenges faced by the microfinance sector in Mexico to fully develop? And of course, I have to make a question about the interest rate, which are still, we all know, so high, but we all know that it's not a specific problem of Compartamos. It's just all over Mexico. The interest rates are very high. So what is the role of the MFIs, of the investors, of the regulators, if they have a role, if you think they have a role, to come together and work in a way that eventually, but not too far in the future, not leaving it to the market to lower down the interest rates? Your personal opinion.
Well, I might say that, and I don't think that this is specific for Mexico, but the context of the industry is very complex, no? And it's not just because of the stakeholders, but I might focus specifically of the players, no? Since they have like different, you have the NGOs, you have regulated institutions, you have commercial banks, no? And you have the informal lenders, no? So this gives you like a very complex context in terms of the players that are in the field at trying to serve and to attend the clients, no? And I will say that this is the main challenge, no, for the industry, no, and also for the policymakers, no. And in this, I will try to focus and the concerns of Compartamos and what we have been very actively, not just in terms of the industry, but also in terms of the policy makers, are in three aspects, no. One that we have already mentioned, and it's by all the panelists present here, is the client protection. And in client protection, our main concern is transparency, and transparency not only focused on the clients in terms of pricing, but also in terms of the investors and in terms internally. No, the operation, it has to be very, very transparent. No, the employees have to vision the same things that the top manager are visioning for the company. No. And also in transparency, and this is one of the things that Jody mentioned also, is governance. No, we know that It's not just because once you start talking about client protection and you talk about transparency, immediately it comes to your mind pricing, no? But we know that transparency goes much more beyond of that, no? And it's terms of also governance, no? And also, no, if you see in Latin America, most of the regulated institutions started as the NGOs, no? And they have the governance, no, in certain terms, no, they have stayed as the NGO processes instead of evolving, no, of a regulated company. The other thing, no, that we think that we have to focus, and actually we do not know if we have to start with that, is try to educate our regulators and the authorities, no? And we've seen this through the experiences of the rest of the countries in Latin America, but also in Mexico, no, that they have like a very broad idea of how to bankerize the population, and they are trying to do these policies, no, by the desk, and just trying to imagine, no, what are the institutions or the clients facing, no? And right now and Compartamos is very actively, no, having meetings with regulators and with the authorities, and taking them to visit our clients and to see, no, that what probably they are thinking of, no, it's completely different of what we are facing as institutions that are playing in the market, no? And in that term also, one thing that is our concern, and once that the market is much more mature in terms of players, no? If you know, more or less 6 years ago in Mexico, they were registered around 100 institutions, microfinance institutions, regulated or not regulated. Right now, we have over 1,000 MFIs, no? So the market in terms of players, it has increased, the competition, it has increased, no? So the challenges also are different, no? And are different in terms of client, because what we want to, and we are very concerned, is the over-indebtedness of the client. And we have to promote, no, for example, one thing that we are like, and it's not the thing that it's going to solve everything, but it's a tool that will solve not just, no, for the players and the competitors, but also to the clients, is to have these credit reporting agencies, the credit bureaus, no, that all the institutions have to be not just reporting, but also not just consulting, but also reporting the clients, no? And this will benefit also the clients because they will have a credit history. No, so I will think that those will be the main concerns. And in terms of interest rates, also what you will see through the history of Compartamos is that we have been decreasing our rate, no? One thing that it's important for you to understand is that the business model is completely different, no? We go to the clients where the clients are, no? They don't come to the branches. Our branches are just offices, no, that are mostly to have the loan officers there and to collect all the paperwork that they need for them to go to the meetings, no? And if you see one office, no, covers 2 hours around the zone, no? So our business model is very active in human capital, no? And around 58 to 60% of our costs are directly for the sales force, for our sales force. So this gives you also a completely different perspective on terms of interest rates, no? So I don't know if I answer.
Yes, yeah, thank you very much. Well, I would like actually to take a rest, and I would like to ask you to please ask some questions to our panelists or to myself as well. Don't know if you, yeah, there is a microphone over there, so please raise your hand. Thank you. And if you can state your name and if you belong to any organization of microfinance or why you're interested in microfinance. Thank you.
Thank you. My name is Shamina de Gonzaga, and I'm interested because I spent several years working with the founder of Women's World Banking, Michaela Walsh, on a book that has just come out, but studying sort of the history of the movement and why, with a strong emphasis on the social aspect. And that took us back to the 1950s and 60s and some of the initiatives that were developed then. So I was struck listening to all of you and the promising and wonderful work you're all doing. The comment that Jody, you made in terms of the lack of kind of experience in documenting this specific area. And certainly I can see how it's emerging as a more mainstream interest, but it seemed that there is quite a history and a trajectory that is available and that could inform your area of work. So I'm wondering if you're tapping into some of that past, or are we really starting from scratch here?
There's certainly a lot of history and a lot of very good work that has happened, but the problem is that there's not a lot of specific data. And so if you're going to start trying to model risk, which is really what we're talking about here, it's a social risk, but it can be modeled like anything else, we basically have to start collecting the data. I mean, when we put together our social assessment and the factors and the indicators, we made a lot of use of what had come before and research done by Women's World Banking, the Mix, the SMART campaign, many others, randomized control trials, and so on. But then to actually start looking at what the weighting should be and what performance leads to certain outcomes, there's really not consistent data that's available. I mean, there are randomized control trials, but there are a lot of issues with how those are used and what they really tell you about social performance. So unfortunately, it's not like what we have in the credit markets where there's years and years of data that's consistent and so on. So that's really what we need to deal with.
And can I add very quickly? I completely agree with Jody, and I think in the 1980s and the 1990s we saw a very strong focus on sustainability. So a lot of the institutions, even though their core mission always stayed the same and they were always very much focused on the client, there was a strong wave of making sure that they would be able to do that on a sustainable basis. And really the message from, New York or Washington or Europe was really, you need to be sustainable because the donors are not going to be there forever. So, they became very professional institutions, very efficient, particularly in Latin America. And then somewhere, I think, I don't want to say the client got left behind, but I think measuring what the client valued and making sure that we're meeting those needs got a little bit left behind. But I think, starting, the last maybe 5 years, we've really refocused on that and really, sort of gone back to our roots and put the client first as it always should have been.
Hi, my name is Franklin Moore. I'm also just a fan of the microfinance movement. And I worked in a domestic microfinance organization here in the States. And it was the same thing. It was giving financial services to the unbanked. And, two questions, I guess. One is for Jody. Is there a difference that you're seeing, and for Nicole, the difference that you're seeing in regards to the development goals and outcomes from a for-profit microfinance institution, commercial organization with a nonprofit microfinance institution, specifically in things like you mentioned, like leadership, management, in those areas. So is there a difference based on the legal structure of the organizations in regards to the goals? And a second question would be for Carolina regarding, from my experience here just domestically, we were, it was always about let's be able to give people who are unbanked or underbanked credit, and then let's get them to the point where they can reach mainstream banking, right? And obviously that would kind of take away maybe returning clients for Compartamos. I'm not sure if Compartamos has a more mainstream, kind of banking process for individuals who may get out of that cycle of receiving financing. They may leave their areas, which may be rural areas. Is there any kind of services that go beyond just being able to give them credit, but really kind of get them out of the cycle of kind of being in the exterior of financial inclusion and really get them to the mainstream?
Thank you. Well, I guess at the first question, perhaps I can answer for both Jody and I, because we are drawing from the same data, unless you have other sources that I'm not aware. Yes, actually, we have observed some differences. I would say that when it comes to track social outcomes, namely employment generation, number of business financed, poverty reduction, who is using the Grameen PPI, that is one of the poverty tools now largely promoted by the industry as a quick method to assessing the poverty level of their clients. In that case, I would say that the NGOs are the ones that seem to be more active in tracking that type of metrics. When it comes to the areas of consumer protection, but especially I would say human resources. So when it comes to progressive human resources policies, staff incentives, I would say that it's more of the bank side that probably have something to teach to the no-profit world about how you can make the industry more professional. So these are perhaps the two areas that I've seen slightly differences.
And just, we haven't, in their data, haven't done that breakdown, but just more from anecdotally. One thing is I don't know if it goes by structure, although, a bank can obviously offer more products. And there's been much research on the benefits of voluntary savings products, for example, which, if you're an NGO, depending on the country you're in, you may not be able to offer that. A lot of it also has to do with size, and there have been studies on interest rates as well, and that's also inconclusive, because you might have an institution that's for profit who wants to make money, but they also may be more efficient. And an NGO that's not being driven by sustainability, let's say, or not as much by sustainability because they have donor money, they may be charging a higher interest rate just because their costs are higher. So I don't know that, there are benefits to each of the structures, but I don't know that there's conclusive evidence that a structure drives the impact.
And for your second question, let me see if I catch it correctly. No, it's if we graduate these clients to a more sophisticated financial institution. No. And what we have seen is that the simple products, simple operations work the best, no? And not just in terms of internally of the operation, but also in terms of them to understand what they're facing and what they're asking and what they're receiving from the institution. And as Rebecca told, is they're very, very sensible, no, for customer service, and customer service being more a personalized service, no. So that's why it's really critical the role of the loan officer, no. Even though some of them can graduate and ask for typical individual loan for a commercial bank, no. They don't go, most of them, because the requirements are much more complex. No, in Mexico, for example, they require to have income statements and that they are like registered in the tax authorities or whatever, no, and they tend to not to do that, no. It's really for them, it's too complex, and they have that idea, no, that if they go and ask, it will take them a lot of time, no, and the documentation, they're not going to have it, no, because they do not register their sales, they don't have this income statement, they don't have to prove anything, no, they have more an empirical way of handling the business, no, and on the other way, no, they really appreciate when the loan officer goes to their businesses and visit them, and practically the loan officer not just know about the business, but knows about the family, no? So I try to see this, that in the past, I think that this is where in the 50s, no, when our parents or our grandparents went to the bank, no, that the manager of the bank really know all the customers, no, that's why what they really appreciate and still appreciate it.
Thank you, Carolina. I think we have time for one last question. Oh, we have 2, 3 questions. I think the lady here was first, probably. Okay.
Thanks. My name is Alana Tumino, and I work in our policy department here at the American Society and Council of the Americas. So the question is, we started off the panel by saying how social performance is such a hot topic right now, and because of that, we've seen in the past few years a plethora of different initiatives that measure and track social performance. So my question actually is from the MFI's perspective, how have you guys seen that they're navigating this huge and growing field of social performance, whether it's social performance, the different social performance ratings that are out there in assessments, whether it's reporting their indicators to the mix, whether it's reporting pricing transparency, whether it's implementing client protection principles. There's so many different initiatives, it seems like, out there. So have you seen that this has been a challenge or some confusion on the part of the MFI in trying to kind of uphold all of these different standards, as well as if they've faced, financially and institutionally, this also is a huge, not burden, but a huge, burden for the MFI as well to uphold all of these different standards. So the question is, what have you seen from the MFI side in respect to this?
Thank you. Before answering this question, actually, I just wanted to hear what were the other 2 questions to see, actually, if we can group something. I don't want to leave those 2 left out.
My question was, you've talked about data collection. How has technology changed in the past couple of years, both on the MFI side? Is it easier to collect data? Have you seen any partnerships with big companies that are helping out with this? And then also from the borrower side, have you seen mobile banking? How is technology making their lives easier?
And thank you. I come from an NGO perspective, so it's interesting to see the MFI experience go through the same process of moving from intermediate indicators to outcome tracking and things like that. I guess my question is, the next step in this is getting to impact, which requires attributing causality. And to what extent do current initiatives risk enshrining best possible practices for the immediate future with best practices? And how do you ensure that you continue to push these MFIs going beyond where you're pushing them right now? And if that is a goal.
Very good, thank you. So 3 questions: reporting burden, use of technology, and how can microfinance world get together with the academia world to make the most out of this information to measure eventual impact. Perhaps I can start by answering about the reporting burden. Yes, we all agree it's terrible. But it's not just about social performance, it's also about financial performance reporting. The MFIs have to report to MICS, to the regulators, to local government, to their investors, to funders. It's terrible. Actually, MICS is currently just working on a new project to try to come together with the main stakeholders of the industry to come up with one type of reporting platform so that the MFIs can finally reduce this terrible reporting burden for both financial and social performance. So I will just say stay tuned. We will give you more update in the next month. Now, about the technology, I don't know if here maybe Rebecca or Carolina want to address according to your experience with that.
In Mexico, no, the context is completely different. In terms of mobile banking, no, we have to work with regulation, no? And we have to work with I might say, the monopoly or the oligopoly that we have in terms of telecommunications. No, we have Mr. Slim, owning the largest Telefonica, which is Telcel in Mexico. He also owns a bank, but we are tied in that way, and also in terms of regulations. And on the other hand, the other thing that we are facing is the culture, and it's much more simple than what we can imagine. And in terms of culture, is that the paper, the black and white paper, still has a power in the low-income segment. They do not trust that much technology on having the transactions. They want a printed copy, a hard copy that they have made a payment, or that they have made a deposit, So, as in Mexico, we're still facing that, but we know that in the near future, the paper will still be one of the things that we are going to face and our challenge.
And just to add, what we've seen is certainly other regions, Africa, Asia, have been much quicker and have implemented technology significantly more than Latin America. And I think what Carolina's saying in terms of the regulation, but also the systems that are already in place, institutions that are, much bigger, very efficient, that have already established credit methodologies and processes, it's much more difficult for them to adapt to new technologies. So this is certainly an area that we've been working with some of our network members, but I think there's a lot of work that needs to be done. And I think on the social impact question, if I may, our focus has really been, as I mentioned in the beginning, practitioner-driven. What is practical? What can management use on their day-to-day? So we've really focused on social outcomes, social outputs. Having said that, impact in microfinance is very difficult to measure, as Jody was saying. If you look at the health sector, for example, you look at a vaccine, you can measure very easily if a person didn't get sick because of that vaccine. It's much more difficult to measure whether a woman was able to grow a business because of a loan, because it could have been the loan that led her to grow the business, but it could also be her entrepreneurial spirit. It could also be the market. It could also be her kids that are helping out. So there's a number of factors that make measuring social impact very challenging. There is, as Jody was also mentioning, RCTs, and we do see a big role in the industry for that. However, there's, that's in a way left to the academics. Institutions, it's very costly to do an RCT. It's very costly to measure social impact. And if we do it on a continual basis, institutions won't, in a way, what do you prefer? To use that money to actually be able to serve the client and provide loans, or to use that money to measure how you're impacting the loan? We still think there's a place for them, absolutely. The soap opera that I mentioned earlier, we actually did a very comprehensive impact study of that soap opera. Because if it's such an innovative project, we want to make sure that we are able to replicate it in other regions. So we engaged ICRW, a very well-known research firm, to do that and to really conduct one-on-one surveys and be able to measure social impact. And through those learnings, we're now able to replicate. We're actually now developing another soap opera in Kenya, or actually working with an existing soap opera in Kenya. So again, there is a role for social impact in the sector, but I think in a way that's best left to the academics.
Great. Actually, I would like to ask Jody if he has something to add.
I always have something to add. And these are the types of questions that actually on the impact of the different initiatives that when I answer it, I usually get myself in trouble. But I'll try not to do that. There are a lot of different initiatives, and there's been a lot of effort to try to harmonize the different initiatives. And I'd like to combine that with the idea of impact, because my fear is, and I think, first I should say, I think a lot of these different initiatives are very good. For many, many years, no one was doing anything. And so you needed to get standardized data. You needed to come up with what do we mean when we talk about social performance? What do we mean when we talk about impact? However, and this is where I get in trouble, if you have too much harmonization, what you have the risk of crowding out is innovation. And this goes exactly to the point you were saying, is that if everyone's been invested in one harmonized standard that's not really based on empirical research, then it's easy for us as a rater to say, well, that's what everyone wants. If we fight that, then we're the odd man out. And so what's our incentive for fighting that? What's our incentive for coming up with something different? And so if you have too much harmonization, and those are the indicators that everyone agrees on, and no one's doing anything different, you got to be really, really careful about that. The other issue that I have is, just think about if we were to do this harmonization, and it wasn't in microfinance, but it was Moody's, Standard & Poor's, and Fitch, said, you know what, we've all agreed on what the methodology is going to be, and we've agreed on exactly what we're going to measure and all that. I think people would look at that and not say that's a really good thing, right? But they do say that in microfinance. Right? If it was a ratings, we call it collusion. In microfinance, it's harmonization. So, we got to be a little bit careful about how much we harmonize to the point that we leave room for different points of view, different types of research, and incentives to be able to do that, to differentiate how you're approaching these markets. So hopefully I didn't get into too much trouble.
Very good. So I think there is no more time. Thank you so much for your attention. And an applause to our panelists.